Good afternoon, everyone, and thanks for joining us today for our annual Queen's University Pension Plan Annual General Meeting. My name is Steve Milan. I'm the Associate Vice Principal Human Resources here at Queen's, and it's great to be hosting the meeting today. We'd much rather be doing this meeting in person, but as you all know, that is not a thing that we can do these days. So I'm happy to do this in a remote fashion using our Teams platform. Before we begin, I'd like to acknowledge that Queen's is situated on the traditional Anishinaabe and Haudenosaunee territories. We are grateful to be able to live, work, teach, and learn on these lands and waterways. So just a few housekeeping things before we get going. So just in terms of logistics, we will be taping today's session and we will be posting that on our website so that you can view that either at a later date, or for those that were unable to attend today, they will have access to the recorded version of today's annual general meeting. There will be opportunity, and there is opportunity for you to ask questions. So in order to ask questions, or to submit your questions, I would ask that you use the question and answer box that is available as part of the Teams function. So if you have a question, please type it into the Q&A box, and we will try to get to as many of the questions that we can during the time that we have. And if you are having technical difficulties, I feel like an IT person when I say this, but it's probably best to log out of the call and then log back in, which is, I guess, the equivalent of turning your computer off and on again. So again, welcome to everybody that has joined us virtually. And what I'd like to do next is maybe just go through the agenda for today. So the meeting itself is going to be broken down into a couple of sections. Once I finish here, I'm going to turn it over to Jim Kahane. Jim is the chair of the Queen's Pension Committee of the Board of Trustees. After Jim's initial remarks, we will have a portion of our meeting dedicated to the Queen's pension plan. So there'll be an update and then an opportunity to ask questions. So you'll hear from Bob Weisenagel, who's our Senior Director of Pensions Services here at Queen's, Manuel Ontario, who's our plan actuary, and he's with Mercer's, and then also Brian O'Neill, Director of Investment Services. So many faces that you will have seen at prior meetings. And then we'll finish our AGM with some time to talk about or receive an update on the UPP. So we're happy to have Gail Rubenstein, who's the chair of the UPP Board of Trustees, and Barbara Zvan, the UPP President and CEO, with us for the last part of our meeting. So with that, I'd like to turn it over to Jim Kahane. So Jim is the past president and CEO of Healthcare of Ontario Pension Plan, so HOOP, and Jim is the chair of the Queen's University Pension Committee. And Jim's only able to join us by phone today, but Jim, I will turn it over to you.
Thanks, Steve, and I'm sorry I can't be on the call and video. We had some technical challenges, so you only get to hear my voice instead of seeing my face. But anyways, we'll do our best. So this is a milestone meeting. So because of the pending merger with the University Pension Plan, assuming everything's proceeded as expected, this will be the last annual general meeting of the Queen's Pension Plan. Because of that, we just look back into some history on the Queen's Pension Plan, and the first meeting of the pension plan took place on September 30th, 1969, and the most recent meeting that we had held in September was the 219th meeting of the Pension Plan Committee. And for these annual general meetings, they actually started in January 1975. So this is the 45th year we've had a meeting of the annual general meeting. So it is a milestone event, being the last particular one. So well, hopefully that everything will go through fine and it won't be a 46th meeting because that'll. But I think the move to UPP would be a great thing for the pension plan. So I just thought I'd just give a couple of high-level comments on the results that we've had over the past couple of years. So it's interesting. I mean, investment returns have exceeded expectations, and Queen's University, the employer, has actually made significant special payments into the to shore up the plan. And so, but despite all this, the funded position of the plan has actually deteriorated. And the culprit for this really is the very low interest rate environment that we now find ourselves in. And I know any of us that are savers experience this challenge, that it's very hard to earn a return on your money these days. So on a going forward basis, investment returns are expected to be lower due to the very low interest rates. And when you're figuring out the funded status of the plan, there's a bunch of different moving parts, but essentially you look at your current assets and our future cash flows and the returns that you can earn off those assets and future cash flows, and then you would subtract the payouts that you owe to pension members that are in retirement, and that determines your funded status. And so because of these very low interest rates and low expected returns because of that, it makes the balance between those things much more challenging to balance those things out, and because of the lower expected returns. So we'll get a bit more detail on the next section of the presentation when we get some more detail from the both our actuaries and our pension people from Queen. So, talking about I just want to talk a bit about the UPP right now. And so I just recently retired earlier this year in March of this year. And so I feel very fortunate to be in a defined benefit pension plan. I think all you people everybody here should be very fortunate, feel very fortunate they are in one of these plans. Because what I found is that, the payouts I've received every month from my plan is really allowed me to maintain my standard of living in retirement and be able to do the things I want to do when I'm retired. So it's really a tremendous thing to be in one of these plans. And I think there are significant benefits to moving into the university pension plan as well that'll make the plan more sustainable over time. And I think one of the biggest things really is the benefits of scale of being in a much larger plan, because what that enables is the fund to engage in a wider range of investment options. So there's certain investment activities that you really can't do through an outsourcing environment, and if you can insource those things, you can do them much more effectively. Also results in much lower costs. So the returns are your returns after costs. So if you can keep your costs lower, the returns will be better over time on a net basis. So lower costs due to scale is a big benefit of being part of this new group. But also some other intangibles that you don't think of. I mean, just being able to have a larger pool enables to engage in activities such as better risk management functions, better systems, things like that really you can do at scale. That's very difficult to do at a lower scale. So again, I think it's a very positive thing for everybody here to be moving into the university pension plan. So today we're very fortunate to have two members of the university pension plan here who will provide you with an update on how things are progressing. And it's Gail Rubenstein, who's the chair of the university pension plan, and Barbara Zahn, who's the new CEO of the university pension plan. And I'll give you a more detailed introduction to those individuals in a few minutes, but I would just say that they're both outstanding individuals, and we're very fortunate to have them running the pension plan. So that concludes my opening remarks, and I'd now like to turn it over to Bob Westnagle, Manuel Monteiro, and Brian O'Neill, who will give you a detailed update on the Queen's pension plan. So over to you, gentlemen.
Okay. All right, good afternoon, everyone. It's Bob Weisnagel. It's almost a pleasure to see everyone today, and as opposed to prior years when we were meeting in person and had the opportunity to have a good dialogue back and forth. We are doing it the way that we need to this year, and we'll plow ahead with what is a typical slide presentation that we've had in prior years. And despite what Steve Milan might suggest, while I've been with the pension unit for quite some time, I was not there for the first pension committee meeting in '69, nor was I there for the first general meeting of the plan in 1975, but I've been part of this presentation for quite a few years now, and I'm looking forward to providing these numbers once again. The first slide is really just a summary of the plan membership, and what's interesting to note on this slide is the particular growth in the number of members over the last few years. So the QPP is very much a mature plan in that we have quite while on the one hand we have quite a few active contributing members, we also have a growing number of pensioners drawing pensions monthly, and what that means in practice is the contributions that go in on a monthly basis are not sufficient to meet the monthly pensioner payroll, and so we have to have a fairly dynamic input from investment services to keep this mature plan going on a month-to-month basis. This particular slide, as we've seen before, is just a reconciliation of the membership since our last evaluation, which was in 2017. And at that time, we had just slightly under 8,000 members, but since in the last 3 years, we've grown by over 500 active members. Now, this slide is a particularly complicated slide, and it's one that pensioners have seen often in the past because it serves a couple of functions. One, it shows how the post-retirement indexing adjustments have occurred over the past decade. Of particular note, and a note to current pensioners, is that adjustments to their annual paid pension are directly related to investment returns of the fund. Bedrock principles of the pension plan is pensions once in pay are guaranteed to never reduce, subject to this annual post-retirement indexing adjustment process. What happened in what is illustrated in this particular slide is the market meltdown of 2008 had a significant impact on this post-retirement excess adjustment process. This slide generally applies to people who, members of the plan who had pensions in pay prior to the meltdown, and what happened since that event in terms of their post-retirement adjustments. This chart shows that if a starting pension prior to the meltdown was $3,000 a month, the true value of the pension on an annual basis declined over a period of years because of the 2 negative years of returns that resulted from that meltdown. Returns rebounded, and we started to see positive indexing adjustments each year. However, those positive adjustments were first applied to make up the paper deficiency, bearing in mind that pensions in pay never reduced, but the background true value of the pension was tracked, and the positive returns in subsequent years were needed to offset the prior losses. Eventually, it took a decade for the total deficiency to be fully recovered. And last year, this large group of pensioners received their first, albeit modest, increase, which put them back into a slightly into above water in an increased territory. And this year, despite the pandemic, and much to our surprise, the fund returned quite strongly over the course of the summer and finished the year at 7.7%, which once again resulted in a modest increase to this pensioner cohort's pension, and their pensions went up by 0.5% this year. I appreciate that this is a particularly complicated matter. Ordinarily, I'd like to field questions at this point, but we'll have to go back to this slide at the end if needed to answer any questions. And as Jim noted, the financial position of the plan has been in an underfunded position for a number of years. resulting in special payments being required by the employer to fund the plan. This is an update through August of 2020, showing that once again, this year's required special payments were in the $20 million area, and it just shows that it's been over a decade of special payments that have had to been added to the plan by Queens because of the funding requirements that flow from our annual valuations. And despite the positive return that we had this year of 7.7%, we are probably in not a much better position. While the assets are improving, the liability side of the ledger continues to deteriorate, as Jim might have noted, and that matters at this stage of the calendar, in the sense that after the last filed valuation was 2017, which means that we are required to file a valuation as of August 31st, 2020. We have to require no later than every 3 years. So this valuation as of 2020 would be the driver of the next round of both required and, if needed, special payments to meet the plan's funding obligations. Manuel Montero, the plan's actuary, Mercer, presented some preliminary numbers at the Pension Committee's December meeting, so just last week. I'm just about to flip the slide over to the preliminary numbers, and I will let Manuel speak to where that points to in terms of funding status. So over to you, Manuel.
Thanks, Bob. So as Bob and Jim mentioned, we have to file a valuation as of August 31st, 2020. The last valuation was filed as of August 2017. So when you do a valuation of a pension plan, there's two types of valuations that you have to do. The first one is what's shown on this page, which is a going concern valuation, which essentially assumes that that Queens continues as the employer and that the pension plan continues forever. The one wrinkle this year is because of the pending move to the UPP, our valuation as of August 2020 does reflect the fact that benefits under the Queens pension plan provisions will cease to accrue at the end of June of 2021. So looking at the results here, you can see that the last valuation on a going concern basis, the plan was in a deficit of about $31 million. At this valuation, so 3 years later, despite the strong returns over those 3 years, the deficit has actually increased to about $260 million. The big reasons for that is two things. One is there's a new requirement under the Ontario legislation to include what's called this provision for adverse deviations in the valuation. So that's, you can see we're holding an additional liability of roughly $212 million. And the other reason is what Jim alluded to at the beginning, is that we've seen a period of interest rates get lower and lower and lower, and the valuation, as a result, the expectations for the future returns that can be earned by the pension fund are lower now than they were 3 years ago. And so for this valuation, we're using a discount rate of 4.7% compared to 5.6%, which is used at the last valuation. So those two factors, the requirement to include the provision for adverse deviations, as well as the fact that we have to use a lower discount rate because our expectations for future returns are lower, are the two main reasons why the deficit has increased despite the strong returns on the pension fund and the contributions that Queens has been making to fund the deficit. Next page, please. The other valuation that we do is a wind-up valuation. So this is obviously based in a scenario where the plan is terminated and you're looking at what is the cost of actually settling the benefits that have been promised to plan members. On this basis, when you're settling a plan, you're really looking to buy annuities for pensioners and to pay out lump sums for active members. At a high level, that's the process that you follow. And obviously, both those things, the cost of annuities and the lump sums that you need to pay out, are very much driven by market interest rates, which, as we just discussed, have fallen pretty significantly. So even on this basis, you can see that the deficit, the last valuation, which was much larger, was about 317 million, has grown to about 436 million. The biggest driver there being the very sharp drop in interest rates over those 3 years. So putting those two things together, you can see that the deficits are up from the last valuation. And so in the absence of the move to the UPP, these deficits would need to get funded. Luckily, the way that the Ontario legislation works is you can actually start funding deficits 1 year after your valuation date. So given the pending move to the UPP, even though these paper deficits certainly exist in the funding valuation that will be filed with the regulators, there will be no requirement on Queen's behalf to actually fund these deficits, because starting July 1, 2021, Queen's funding requirements and valuations will be under the UPP. So I think with that, I'll pass it on to Brian.
Yep, perhaps before passing it along to Brian, I just wanted to note this next slide, which is a detailed breakdown of the fund rate of return and how that was arrived at this year. And plus, there's one other point that I wanted to raise in respect of the excess interest adjustments that we do every fall. One of the features of the transition over to the new UPP is that existing pensioners who are having their pensions under the Queen's Plan adjusted on this basis will continue to have their pensions adjusted annually exactly as they are done now on this excess interest return process based on a rate of return earned by the funds. That will continue post-conversion to the UPP. In addition, members of the plan who initiate benefits after conversion, so they'll have most of their initial benefit based on the Queen's side of the plan and some of their benefit based on the UPP side of the plan. The Queen's side will continue to be administered exactly as it is now, which is on a hybrid basis, and in the future annually will be adjusted exactly as our other pensioners based on the rate of return earned. In this case, it'll be the rate of return under the UPP. So the Queen's side of the ledger continues to be administered pretty much as it is right now, even after conversion, and exactly at the same time of year, based on an August 31st rate of return, and processed during the fall with an if there's a positive adjustment, that a positive adjustment occurs December 1st. And as you can see from this slide, the rate of return, despite all the pandemic volatility of the past year, was close to 8%, 7.72%. And at this point, I'll just pass the mic, figuratively speaking, over to Brian to speak to the investment side of the plan.
Okay, thanks, Bob. On the next slide, I'll be talking about how the investments are actually managed now. Obviously, we won't be talking about how things will be managed after the UPP merger, but currently all the assets are managed externally by professional investment managers with areas of specialization by asset class. We don't do any internal stock picking or anything like that. So you could think of us as an institutional manager of managers, and they're all listed here on this slide. The target policy asset mix is 53% public equities, 37% fixed income, and 10% real assets, which includes infrastructure and real estate. Of note on this slide is that I'd say over the last 6 or 7 years, there's been a shift in our emphasis somewhat toward more alternative asset classes, specifically infrastructure, real estate, and private fixed income, with OMERS and Sun Life specifically. We've also made more use of passive investing. So these are funds that closely track broad public market benchmarks, and they do so at a very low fee. And there are a few reasons for that, but while we still believe in active management, passive management had not been used very much previously, and there was a fair bit of overlap, I think, in our managers, so we've been trimming the list gradually over the years. And we did feel that cheap beta, as they call it, could play a key role in a well-diversified plan. There was also the knowledge that the UPP merger was approaching, and so that would make passive strategies even more attractive to active managers requiring at least a few years, ideally a full market cycle, to allow their strategy to demonstrate their merits. So it would have been tricky to hire a new manager a couple years ago, for example. So the fee benefits are real too. The total fees on the QPP are now around 40 basis points. I say around because there are performance fees in certain cases which can fluctuate significantly, but in any case, it does kind of show the benefits of institutional investing is that our fees are quite low, and that's all in. That includes actuarial fees and so on. I don't have a slide on this, but I wanted to point out quickly that we have a really strong responsible investing policy and procedures, and these are informally based on the United Nations supported principles for responsible investment, and with the really increased emphasis on ESG considerations. We've been very active in 2020 implementing the directives of the Board of Trustees Climate Change Action Task Force. And they made a number of recommendations, mostly relating to the endowment for practical purposes because of the upcoming merger. But of particular relevance to the pension, I think, was that we were asked to improve our responsible investing communication significantly, starting with our website. And so we have done that. So if you're interested, you can check out the Queen's Investment Services website, which went live 2 or 3 weeks ago. And there's a lot of good information there, including on I think especially on the responsible investing side. And another of the requirements was to review and amend our annual responsible investing questionnaire that we send to each of our external investment managers. And for that, we actually worked closely with the student group Queen's Backing Action on Climate Change, and that was a good process. I think they were quite happy to be involved with that. And so, we significantly revamped that questionnaire, and we made what I believe is an unprecedented step, in Canada at least, by posting these responses publicly on this newly designed website. So if you go to the webpage, you can check out what that's all about and read what our managers' really thoughtful approaches are to ESG in general. On the next slide, we have performance to September 30th that we get from our custodian with BNY Mellon universe comparisons. So Bob mentioned that the 7% net return for the fiscal year ending August 2020 was strong. The current fiscal year got off to a little bit of a bad start. In the first 2 months, the cumulative net return to October 31st was minus 2.4% for those first 2 months. But the market's really rebounded in November. So a preliminary glance at the November numbers looks very promising. I don't have concrete numbers because our reconciliation processes with the custodial bank are still underway. So don't hold me to it, but I think we probably did something like 5.5% to 6% in the month of November alone. So we should be back into positive territory. We show these benchmark and peer group comparisons each year, regardless of whether they're favorable. I always caution that we don't pay too much attention to the broader peer groups, because not all of them have the same, they don't have the same liabilities, they don't have the same objectives and risk tolerance and so on. So they should be taken with a grain of salt. I also always caution about the end date sensitivity of these comparisons. There have been some years where I've stood up in front of this group and the numbers made the pension committee look like geniuses, whereas in the last couple of years, unfortunately, we have had a number of managers underperform, including Burgundy, Leco Brasso, and Orbis. And so on the one hand, I think it is a really good news story that we were able to generate a 7.7% net return over the most recent fiscal year, despite a spectacular market crash in Q1 of 2020. But on the other hand, the committee is mindful that we might have done even better if more of our managers had kept up with their benchmarks or exceeded their benchmarks. So the committee does put a lot of pressure on our external managers and hold them accountable for their performance. And in each case, with respect to these managers I mentioned, Burgundy, Leco, and Orbis, the committee has done a thorough review and decided that there is still a comfort with the manager. But in the last couple of years, we have significantly reduced the allocations to each to reduce manager-specific risk. I think it's also worth mentioning that 2020 showed us the value of a robust rebalancing policy, because when the markets crashed in the first quarter, it's really, really hard to actually buy low, to be a contrarian when everything looks like it's a disaster and the markets are crashing. It's hard to be a buyer, but our rebalancing policy enforces that discipline on us. So we actually ended up investing about 60 million, redeeming from fixed income and investing about 60 million into global equities, really close to the market bottom in mid-March, which turned out to be a fantastic investment for us. And on the next slide, finally, we have historically shown the results from the annual survey of CABO, the Canadian Association of University Business Officers, which includes nearly 50 Canadian university pension plans. These numbers come from what feels like a lifetime ago because they're pre-COVID and pre-market crash, so I won't say too much about them, but we do show a couple of meeting comparisons in this table. One is for all of the plans in the survey, and the other is for the plans that are larger and separates them out. You could make a case for either comparison, but again, I would note that the pension committee is not overly concerned about what other plans are doing. Having said that, depending on the time horizon, it more or less points to us being middle of the pack at this particular point in time when this survey was conducted. So that's all the comments I had. I think I'm throwing it back to Jim, if I'm not mistaken.
Actually, it's Steve here. Maybe thank you, Brian and Manuel and Bob for those presentations. I do have a few questions from our audience that I think it would make sense to kind of tackle now. So probably the first one is maybe to Brian, and Jim may want to weigh in. So it's around our asset mix. So considering equities performance in recent years, is there a consideration to do a different mix of holdings or raise our risk tolerance to alternative investments like real estate? And then kind of a second question, somewhat related to asset mix, is with the long-term interest rates so low, are we planning to continue to have as much invested in fixed income as we might have now? So really some questions on our asset mix. And I believe Barb will talk to that a little bit on the UPP side later on, but maybe I'll turn that over to you, Brian, for a response.
Yeah, and I'm sure Jim will have comments as well. I guess the short answer is no. We're keeping our asset mix as it is. I mean, they're definitely fair comments. I had mentioned that it's tricky for us to make new commitments to investments and say, well, even to public equity managers, but certainly if you're looking at the private asset classes, private equity, real estate, infrastructure, would have been really difficult, I think, for us to make new commitments to asset classes of that nature when we knew that the merger was coming up. So certainly these will be challenges for the UPP. I think really, how do we deal with an asset mix? With our asset mix in an extremely low interest rate environment, and also with equity valuations where they are. Not sure if Jim has anything to add to that.
Sure. I mean, what I would comment is that, you know, I would agree. If you just look at fixed income from a pure investment point of view, right now it does look, I would say, very unattractive. You know, you've got 10-year government of Canada rates under 1%. So, you know, your upside is you can make 1%, which actually doesn't fund the pension plan. And your downside risk can be significant if rates go higher. So bond risk return trade-off does not look particularly attractive at all right at the moment. But if you frame it another way, which is look at, I mean, the reason why you own bonds in some sense is for a couple of reasons. Is for diversification. So, you know, if interest rates do continue to decline, you will earn a high return on a bond portfolio. And in that scenario, you may do poorly in an equity portfolio. So it does have a diversification benefit to owning fixed income. And yet the other way you look at it is, I mean, there is some interest rate sensitivity in your liability. So the reason why you own fixed income investments in a pension plan is to defease that liability in some sense. So now, as interest rates come down, that exposure becomes lower. So you need to own bonds goes down. So all these things are things that you balance out in terms of the amount of fixed income you have in the portfolio, and we may have been making bigger moves than we are right now, just because of if we were going to continue as an independent pension plan. But because we're going to merge with the UPP, I think it would be inappropriate at this point to make significant changes like that. And I think it's so we essentially maintain the asset mix where it is move in order to move into the UPP. So so it's a good question. I mean, I think fixed income doesn't look particularly attractive, but then to move into something else, you really are moving out the risk curve, increasing the risk in the pension plan.
Thanks, Jim and Brian. A couple more questions. Probably this one is for Bob. Bob, why are the additional voluntary contribution ending with the conversion to the UPP? So why will members no longer be able to make those additional contributions?
Well, one of the significant changes that is going to occur when we make the conversion over to the UPP is the contribution rates in the defined benefit UPP are much higher, which basically uses up, for practical purposes, the room that we have allocated in the past to additional voluntary contributions. So given that the contribution rates in the Queen's plan are lower and were lower in prior years before we made the increases, even with the higher contribution rates to the QPP, there was always room left over that would have flowed into your unused RSP room after each annual tax assessment. Once we move into the UPP, the contribution rates on both the employee and employer side are significantly higher, and for all practical purposes uses up all the RSP room that would have been generated in any calendar year. So from a practical standpoint, there's the contribution rates in the UPP being at the level that they're at. There isn't a lot of RSP room left over each year to use in the ABC program that we've had.
Thanks, Bob. Couple of questions on the changes to our early retirement rules as we move into the UPP. So the question is, will there be a change to the early retirement adjustment that is currently part of the QPP, and what is that change as we convert into the UPP?
The change there is essentially what is often referred to as an 80 factor in a defined benefit plan. So many defined benefit plans have what is referred to as the magic number or an 80-85 factor. And in a defined benefit plan, bear in mind that if you retire early, it's a formula-based pension. And that formula pension at early retirement is reduced because you're starting early, much in the same way that the Canada Pension Plan benefit is reduced if you start it before age 65. So there's kind of that coordination between the two benefits. That being said, in many defined benefit plans, what they have is the magic number or the factor, which is a combination of age and service hitting a number. So for example, magic number or an 80 factor would be minimum age 60 and 20 years of service, totals 80. So once you've reached that magic number, the reductions that would ordinarily apply to your pension at early retirement are removed. So you get an unreduced pension at early retirement. That's how these magic numbers work. We did not have that in the Queen's plan. Generally speaking, in our hybrid plan, if in my experience, individuals who have gotten to that stage, they're 60 years of age and have 20, 25, or 30 years of service, typically their pension would be based on the money purchase side of the plan. Now, if we had the factor operating in the Queen's plan and we took the reductions away from the minimum guarantee, the unreduced minimum guarantee almost in every case is still less than the pension you were getting from the money purchase side of the plan. So even if we did have that factor under the Queen's plan in the past, it wouldn't have benefited very many people. Because it was a hybrid plan, we weren't able to do that. But now that we're moving into the UPP does have that 80 factor as part of its terms and conditions. So if you retire at age 60 or later, so the minimum age is 60 and your age in service totals 80 or more, the benefit that you'll receive from the UPP side of the plan will be unreduced if you retire early between 60 and 65. Now, because of the negotiations that occurred as a lead up to the consent process to convert to the UPP, that 80 factor is now being applied to the minimum guarantee piece of the Queen's benefit. So once we transition over to the UPP on July 1st, retirements that occur after July 1st will have that 80 factor available to be applied to the minimum guarantee on the Queen side as well as the UPP side. But for practical purposes going forward, what really matters is the minimum guarantee flowing from the Queen's or the QPP side of the plan. If you're 60 and you've got the factor, then that minimum guarantee is unreduced. So the hybrid comparison, which will continue, is we'll look at the annuity provided by your account balance and compare that to the unreduced minimum guarantee output, and you get the greater of the two. Very long way of answering the question. Yet, yes, there will be a factor applicable to both sides of the plan after conversion. And if you have the factor and you're at least 60 years of age at retirement, the minimum guarantee is unreduced, and then you get the greater of those two benefits.
Thank you, Bob. We do have some other questions, but in the interest of time, I think we'll move forward to the UPP portion, and then if we have time at the end, we can come back to some of the questions. So I'll turn it over to Jim Kahane to introduce our UPP guests.
Thanks, Steve. So it's my honor and pleasure to introduce our two guests, Gail Rubenstein and Barbara Zahn. And so as Steve mentioned earlier, in my previous career, I was the CEO of the Healthcare of Ontario Pension Plan, and in that role, I did have the opportunity to meet both Gail and Barbara, and I must say they're both very highly regarded members of the pension community, and very fortunate to have them as part of UPP. So I'll start just by introducing Gail. Gail Rubenstein is a partner at Goodman's and LLP. She's a lawyer. She's been recognized as a leading practitioner in the fields of corporate restructuring, pensions, and regulatory matters over her career. And I had the fortunate first meeting Gail sitting on the other side of the table from her, and when she represented the Ontario government in negotiations with several pension plans. And that was a complicated negotiation involving multiple stakeholders, and I must say that Gail very skillfully moved things along to get to an agreeable settlement with, again, a lot of stakeholder groups with different agendas, and so she did an exceptional job at that. So Gail has had a very distinguished career, and she, again, is very highly respected in the pension world. So, and I welcome Gail to the meeting. She's a great person to have as the chair of the UPP. Next, Barbara Zahn, and Barbara is the new inaugural president and chief executive officer of the University Pension Plan, and she's the former chief risk strategy officer for the Ontario Teachers Pension Plan, which is one of the most respected plans in the world, and really was the start of the Canadian pension model, which is very renowned around the world. So again, I have known Barbara for many years. When the large pension plans frequently work together on common issues, and so I did have the opportunity to work with Barb on several fronts. And she is very highly respected in the pension industry, and I've always been very impressed by Barb. So Barb, by way of background, is started her career as an actuary. She's a fellow of the Society of Actuaries and the Canadian Institute of Actuaries. And again, we were very fortunate to have somebody of Barb's caliber as the initial CEO of the UPP. And I'm sure she'll do an excellent job for us. So with that, over to, I think Gail will be the first speaker.
Well, thank you, Jim. Those are very kind words, and I really appreciate them, especially coming from someone who's got your background and your reputation. So thank you for that. And thank you for the organizers and for everyone who invited us to attend today. I'm speaking on behalf of both Barb and me in saying that this is really a great privilege and a great pleasure. This is the first large group of what will be our members that we've been able to address, and that's very exciting to us. It was exactly a year ago today that we had our first meeting of what were then the nominees to be the trustees of the UPP. And it was a meeting to meet and greet each other before the holidays, but also to explain what the really solemn and serious responsibilities were that a member of the board would be undertaking. And we talked about fiduciary duties. We talked about the nature of the trust that was being imposed with us, as well as the fact that we were going to be the board of a startup. And so it's not exactly Silicon Valley, but it has all of the elements of a startup. No management, no office, no anything. And that meant that the board would eventually become an ordinary type of governance board, still with these great fiduciary duties. But for the next year, year and a half, we knew we were going to be a working board that had a lot of jobs to do, and we wanted to make sure that everyone was comfortable both with the nature of their obligations, but also with the amount of commitment that they were reposing. And the group was excited. The idea of joining something new was very exciting to them. Some of them also had been involved with the creation of the UPP to begin many years ago. So it was a great first meeting, and it was a great opportunity to see how excited and committed the trustees were. Now, I'd like to give you in a few minutes, just a high-level overview of what the board has been focused on since it was appointed effective January 1, 2020, and what we are thinking about. And then we'll turn it over to Barb, who can speak to preparation for the launch of the plan in just 6 months. The board, along with Barb and her team, have been and will remain absolutely focused on getting ready for July 1, 2021, when 34,000 people will become members of the UPP. Our goal is to build a pension plan that members will be proud of, that other universities will wish to join, and that we can all feel is entitled to rank with the highest standards of the jointly sponsored pension plans of Ontario. In this work, the most important thing to all of us, and when I say us here, I am including the pension teams at the 3 universities, the universities themselves in their role as administrator, and everyone involved. The most important thing to us is that the transition from your current pension plan to the UPP is seamless and is without disruption, and that you have no worries about that. Nothing will stand in the way of your pension benefits being paid on a timely basis and of the contributions and deductions that have to be made being calculated appropriately. No disruption, no concern. We will continue to work closely with the universities to help administer the UPP for a period of time after July 1 as our agents, while Barb builds the team and the systems and infrastructure to take on the work at the UPP itself. I just want to stop for a minute and explain that agents is a term used actually in the Pension Benefits Act. We as a board have fiduciary special obligations to our beneficiaries as trustees. The Act actually provides that agents of the administrator, which is what we are, also have fiduciary duties, and that it is expected that we're going to have to work with agents. So we're very fortunate, and everyone has understood that we would need to work with the universities for a period of time. Unfortunately, there's no button to press that just all of a sudden 5 different pension plans with 34,000 members will get their benefits calculated and on time. So that's why we're all working so closely. We're also very fortunate that the university pension teams and service providers are outstanding. They're capable and they provide and are committed to a high level of service. And we're very fortunate that they are committed and will continue to do so on behalf of the UPP after July. And of course, no one could ask for better or more caring professionals than Bob and his team, or better or more caring people. So we are truly grateful that Bob will stay on. I'm hoping that Bob will stay on and continue working with us and continue working with you, which is the most important thing of all because of his commitment to you. We keep using all kinds of analogies to describe the UPP situation, like we're living in our parents' basement, like we have a sign out that says, forgive us, we're under construction. It's going to, as we focus on July 1, it's going to take some time for us to, get fancy in some respects and to start moving other things over to the UPP. And we'll ensure that that gets done, but please have a little bit of patience with us. Back to the board. I continue to feel very privileged to say I am the chair, not only of the UPP, but of a board of people who are committed, hardworking, and very respectful. A startup is a journey, and we undertook this without management, but fortunately also without knowing that we were heading into a pandemic. Just as a reminder, the board is composed of 13 trustees and a chair. 6 of the trustees are selected by each of the employer and employee sponsors, and 1 trustee is selected by the non-represented employees. I was selected jointly by the 2 sets of sponsors. The initial terms of the trustees vary. They're 3, 4, or 5 terms. At the culmination of the first term, everyone will have a 3-year term. I have a 7-year term, so I'll be around for a while. Looking back now, it was tremendously fortunate that in those first few months after our appointment, we had an opportunity to meet and to get to know each other. We had 3 formal day-long meetings, breakfast, lunch, dinner, and I will say it, some wine as well, to get to know each other, to form a rapport, and we met many times, with different individuals and also with the working groups, which I'll come back to. But I believe those early months of actual in-person meetings helped us to do what we needed to do in terms of our relationships and our ability to work together, and have stood us in good stead ever since the middle of March. The working groups that I mentioned are in key areas: member services, finance, investments, and communications. We decided to organize ourselves in that way because, first of all, it was the accurate description of what the groups were doing, which is working. And secondly, because we thought it was really important that people would be able to come to these meetings, get the agenda, and feel comfortable that they could join as they chose, but also because they're not decision-making organizations, they're working groups, and the decisions are still all made by the board at the board level. The working groups themselves are informal, not decision-making, and doing it this way allowed us to be more nimble and to get together on less notice than we might have to if we were actually formal committees. The first task of the board was to deal with the regulatory issues and deadlines that were coming fast upon us. And again, we were fortunate to have the support of the sponsors who had done a lot of this spade work on the regulatory matters. I'm very proud to say everything got in on time, particularly that there were a number of applications we had to file by March 31. For whatever reason, we got them in the first week of March, and that gave us a lot of peace of mind as COVID hit, because we didn't have to worry about finding people and all of the things. These were all physical filings. We've continued to work with the sponsors on regulatory issues. And again, I'm very thrilled to say this. Our last regulatory requirements were all met a couple of weeks ago. There were two preconditions to the forming of the UPP. One was the approval of the pension regulator, which we received, and the other was the filing of a regulation by the Minister of Finance, which again we received in November. And we've certainly had superb cooperation from both the regulator and from the Minister of Finance and his staff. One of the things that we also started to do right away was to think about our CEO and what the attributes were that we wanted to see in an inaugural CEO, to develop a list of those and to engage a firm to help us do the search. We began in March and we stopped in March because come March 17th, it was clear to us that you could not start a recruitment process for a senior executive just at the beginning of a pandemic when all organizations were in crisis. So we put that on hold, but we continue to work. We had been already engaged in a robust series of communications with the sponsors committees. That continued. The universities, though I don't have to tell this group, were under a great deal of stress, continue to work very hard at the meeting all of the milestones that were involved with the UPP, and we kept going. But we felt we needed someone with pension expertise as a consultant to the board who could provide support while we were waiting to get our CEO. The one thing about the pandemic was that it turned out Barbara had some projects put on hold and was available and agreed to come and help us, but only on a volunteer basis because she had some extenuating circumstances. And she threw herself into it. We had the opportunity, in effect, to test drive a CEO, and she had the opportunity to test drive a board and all of the circumstances. And we all passed with flying colors, I guess is the right word. We were thrilled to hire her in July. Over the next period, we look forward to becoming a much more traditional board and to handing over all of the reins of work to Barb and her team. But we're sticking with it right now until July and until things all become clearer. So again, I just want to say thank you for all of the assistance and cooperation we've had from the sponsors, the Bob and his team, and look forward to continuing that as we get closer to July. And now I'd like to turn it over to Barb to take us through the next few months and maybe the next few years. Thank you very much.
Great, thanks, Gail. And I would like to also say thank you to Bob and team and Steve and everybody for having us here today, and Jim for the kind words. I got to know Jim over many occasions in the pension industry and always found him incredibly insightful, and congratulate him on his recent retirement. And he left quite a legacy. So very pleased to see him here today and do the introduction. So I really appreciate the opportunity to speak to everybody today, and I'm going to talk about progress in 3 key areas. So first will be investments, moving to member services, and then communications. So perhaps before doing so, I'll say a few words about the UPP team. And at the moment, but not for long, I am the only full-time employee, but I will be joining by an executive assistant, and very quickly afterwards, we're in the final stages of our first member of the management team, which is a chief financial officer and a head of operations, someone with very strong operational experience who will hit the ground running. I've also retained a strong group of people on a consulting basis, some of whom will be full-time as soon as we develop our human resource framework and policies, which I'm aiming for the start of next year. In investments, I'll set the stage a little bit. Our investment strategy at the UPP will be overseen first and foremost by a key document that's required by all pension plans. It's called the Statement of Investment Policies and Procedures, or affectionately known as SIP. Now, you're required to have this, and so we will have one by day 1 or July 1st, 2021. So when we step back to 2020 to prepare for the creation of this key document, we started focusing on what's the appropriate research to do as with the board of trustees and my own due diligence in terms of how to set up the UPP. First was understanding liabilities on a consolidated basis, and then to begin the asset liability analysis to inform what are the possible ranges of the asset mix we may target in the longer run, especially given the current economic environment that were discussed both by Jim and Brian a little bit earlier. We also did a thorough landscape review of peer practices just to inform ourselves and remind ourselves of all the different types of approaches done by the various plans. Now, a key focal point will be responsible investing, which I have been passionate about and committed to for about a decade through my prior role, through my work with the government and different associations. And I'm really looking forward to the conversation about this with the membership in the early spring. Now, we'll be developing the SIP in the first half of next year, which will include discussion and engagement with the sponsors and membership well before July 1st. Now, Gail mentioned the notion of an agency relationship with universities for a transition period of time. So maybe I'll put a little bit more color around what does that mean practically. And so there's really 3 broad approaches that we're analyzing and figuring out what to do by university. Now, the first approach could be where the investment decision and the investment implementation remains entirely with the university. It's consistent with our SIP, the one that's UPP is developing, and the UPP puts in robust monitoring and reporting requirements to the UPP. The second one is where UPP makes the investment decisions, but it's implemented by the universities. And the third is where there's a full transition to the UPP, which takes on the responsibility for the investment decisions and implementation. And we're trying to assess each of these options by school in terms of our ability to be ready to take on the various accountabilities. Now, whatever form of agency agreement will be put in place, it will be governed by this SIP in terms of where do we want to be from an asset allocation point of view. Now, we're also working through the capabilities that we'll need to support day 1 arrangements. So we have retained KPMG, one of the large accounting firms, as a strategic partner to help us. They will help us develop a day 1 operating plan with the CFO and myself to capture the needs of the universities as administrators and our detailed requirements as fiduciaries. And then they'll be there to help us think through options, pros and cons for the transition thereafter. What is our target state? What does that mean from an operational build requirement? What are the costs and what is the time and resources it will take? Now, moving to member services, we know that a full transition of member services to the UPP will be a multi-year effort and will happen in phases and in partnerships with the universities. Now, we're working through the agency agreement with each of the pension administration areas to clarify responsibilities and the scope of the services that everyone will provide, and to arrive at a very collaborative framework that will let us transition over time. Now, we'll begin our strategic conversations with the universities on what member services will look like at the UPP in year 2. But in the meantime, the UPP team will need to do our homework on different options. We're also focused right now on preparing for the 2 first plan valuations, July 1st, 2021 and January 1st, 2022, and developing the appropriate compliance and risk management mechanisms to support the board's duties as fiduciaries. For example, we've begun the process of testing the UPP benefit calculations and making sure, with the key point of making sure that they're consistent and they're aligned across the 3 schools. Now, on the communications front, the truth is you won't be hearing a lot from us for a little while longer, for a few more months, but we're busy. We're planning discussions on the SIP, how to do that engagement, especially in a COVID environment. We've started thinking about the booklet and how to put that together, what it should look like. And then the launch on day one, what should be how do we provide information to members? How do we help them navigate the fact that they'll have a new entity also involved in their pension? We're building out our communication vehicles, including redesign of the UPP website, link to the university sites, and to have a greater social media presence. And we are committed to absolutely no surprise approach, where members are fully informed of the potential changes in their experience as plan members and help them navigate through the different changes over time. On that note, I look forward to any questions you might have for myself or Gail, and thank you for having us here today.
Thank you, Barb and Gail, and really quite interesting, and it's really nice to get an update, and certainly there has been a lot of work done to date, and we're quite excited about the July 1st 2021 transition. Just in terms of questions, we have had a few questions around sustainable investing and divestment, and I would maybe ask Barb for your comments on kind of divestment in terms of potential investments in the future.
Yeah. Thanks, Steve. Yeah, this is obviously an area that we'll cover with the board as part of our responsible investing framework. In the past situations, these have been discussions that I have had with other boards in terms of, as a pension plan, you have a fiduciary duty to your members to act in the best interest. But at the same time, you need to look at these situations that are coming up and say, when I look at it from that point of view, what are the things I'm looking for to say, can it be excluded? There's also many other options. There is the way that you vote for a company, the way that you do your engagement programs. So there's many different aspects of a responsible investing framework that will be all aspects that we'll have conversations with the board. So divestment would be one of them, or exclusion is just one.
Thanks, Barb, for that. I know a number of you have been asking questions that are kind of specific to maybe your circumstance around early retirement provisions and how they might impact an individual's experience. So what I would suggest for those of you who have specific questions, subsequent to the meeting, you can always send an email to our pension department. So it's hrpensions@queensu.ca. And the team there will be able to answer any specific questions that you may have around your individual circumstances. We do have a question around whether the change to the UPP will impact other group benefits, such as medical benefits. And I do want to mention that the transition to the UPP and the pension plan is separate from the university group benefits providers. So there is no change with respect to group benefits that would relate to the transition to the UPP. So I just wanted to kind of answer that question. Just looking through the questions. One of the questions we did receive is, and I'm hopeful that the answer to this is positive, but is there a chance that we would not be transitioning to the UPP July 1st, 2021?
So I'll try to take that. We're working our hardest to make sure absolutely we're transferring. We're also trying to take the approach of, how do we make sure that this is the lowest risk transition possible from the point of view of the members. So I'll give you some examples to help put some color around that statement. So for example, from an administration side, we are leveraging all the existing administrators, relationships, universities, and folks to provide the service, as well as the same custodian who will provide the pension payments. So there's no change in people who were doing it from the prior month to July 1st. And so that really minimizes the risk. In terms of on the investment side, very similarly in terms of how the monies are actually transferred, it's really a change in ownership in the account. So there's no transfer per se. The name of the account is different, and there's no costs being incurred from transferring those assets or risks. I believe Gail has been leading the charge on the regulatory focus, but I believe she mentioned that we've received our final regulatory approvals. So, I'm being a risk officer, you never want to say never from my prior history, but I would say we're taking the avenue of absolutely lowest risk possible and anything going wrong with the transfer date.
Can I quickly comment on that as well, Steve?
Yes, go ahead, Jim.
Yeah, so I mean, usually what would cause something like that to be delayed is the regulatory process, and as Barb just mentioned, the regulatory consent or approvals have been obtained. So I would say, given that that's happened, the odds of it not going forward would be remote. And I know, like Barb, you can never say it's the answer is it's not possible. But I think when you look at the things that typically cause delays or problems with mergers going forward, it really generally falls on the regulatory side. And since those approvals have been received, I think it's extremely unlikely at this point that it's not going to go ahead.
And I'll just, it's Gail. I'll just add to that we've cleared the regulatory hurdles. We have the support of the regulator, the support of the province, and we have the support of the administrators. And I'm not a risk officer, so I'll just say it, although I'm a lawyer, so that makes me always want to have cautionary words. We're going ahead. We will be there for you on July the 1st, and it'll get done. And you'll be proud and pleased on July the 1st to say you're a member of the UPP.
Thank you. Do have a follow-up question just on our commitment to responsible investing, and whether what type of impact do you think that would have on plan returns, investment returns?
So actually, I think it's actually a return enhancer. Actually, I think it's actually a return enhancer in my view. There is, when I began down this journey over a decade ago, there wasn't as much academic research on this, but since then there's been a fair bit that actually indicates if you focus in on the most material environmental, social, governance factors, it actually adds to return and reduces your risk. So I think you need to look at it in the framework of, it helps you drive the value of the company, which is highly correlated in many ways with the values that people have. And that, we are here to do the best interests of plan members. And, those two do actually align when you get to implementation. And so I actually think it's a great tool, and it's been, especially as the data and infrastructure in the marketplace has evolved, being able to do it efficiently and doing it with the insights, kind of like what Brian mentioned in terms of some of the interesting things he's doing, it really enables people focused in the right areas and to ask the right questions.
This is probably more of a question for Bob, actually, related to, I think, more the pension calculator. So as many of our listeners might know, we do have a Queen's University pension calculator available on the Pension Services website that will do pension calculations and projections that combine both membership under the Queen's Pension Plan and the University Pension Plan. So the question is, I think, about the calculator, but also maybe about past statements. But does the pension amount that is shown in the calculator, Bob, reflect today's money, or is it a future reflection of the amount that you would get in the future in terms of a pension projection?
That's a good question. The enhanced tool online does what our prior tool did, as well as our annual statements, which is to project an annual rate of return of 3% on the account balances. But what is different now with the tool is that it assumes for retirement dates after July 1st of 2021, no additional contributions to money purchase accounts, no additional accrual of service on the minimum guarantee side. So in a lot of ways, it assumes that you terminate on June 30th and you become a deferred member for practical purposes. Your account balance will continue to grow with the rate of return of the investment side, but for projection purposes, it's projected to grow at a rate of 3%, just as it has in the past, and just as we did in our annual active member statements, assuming that the fund continues to grow. So in some ways, it's a little bit, it's fixed on the minimum guarantee side. Your salary isn't, your accrual of service isn't going to change, and we've never assumed any growth on the salary side. But on the account balance side, it assumes a 3% rate of return going into the future.
Thank you, Bob. This is probably a question for Barb again, and this is again with respect to sustainable investing and decarbonization, and I was wondering if you could maybe make some comments in that area.
That's a big question there. Maybe I can put my expert panel hat on for the moment, take off my UPP hat. For those listening, I had the privilege as being part of Canada's expert panel on sustainable finance during 2018 and 2019. And obviously decarbonization is critical for us to meet our Paris commitments, as well as to make sure that Canada stays as a productive, prosperous country. I think how we will decarbonize will vary greatly by sector. And I think what you're seeing in the past year is that it is very sector dependent, and you see a lot of groups out there trying to say, here's how you build back better, here's how you decarbonize different sectors. And you're seeing a lot more engagement, I would say, by the Government of Canada, who recently announced a net zero advisory panel, in part to work on those decarbonization pathways, as well as in their economic statement, they talked about bringing together the finance sector and their role in terms of decarbonizing and helping the real economy with that in terms of how they provide finance. So I think there's lots of work to do. It's obviously the trend or the North Star, and the question is how we'll get there, and I think it will vary greatly by industry. And I think investors have a big role in this in general in terms of communicating to companies about having strategies for themselves and communicating with their stakeholders on what they are and disclosing information about that.
Just maybe a follow-up question to that. How would you define sustainable investing, and what criteria would you consider in terms of sustainability?
So I think I have to wait. Okay, there it goes. Well, we did define sustainable investing inside the expert panel report, but I tried to summarize it in terms of using the ingenuity of the financial sector to help spur changes in the real economy. So I think from an investor point of view, when you look at investments, you have to think about the trend of where things are going, what sectors you're in. These are all analysis in terms of what is the growth potential of the different sectors. Where are their boards around these decisions? How involved are they? So when you talk about sustainable investing, it's, it could be related to climate change. It could be related to many different issues that we have in front of us today, both in terms of environment and social. And this is where really a comprehensive framework is important. When we talk to different pension plans across the world, they will all have different particular areas of focus. And countries have different focuses. So I think, it's really trying to say, aligning the financial investments with what are the big changes that you need in terms of your real economy and your environment and your social needs to really build a resilient future for everybody. And I know that sounds pretty broad, but you can get into some specifics as you talk about sectors and things that you need to do.
Thank you, Barb. Probably the next question is for Bob, actually. So there's just a question around whether a member can withdraw the commuted value of their funds out of the pension plan moving forward.
Yeah, there has been an agreed to phase in of that option because the one difference between the Queen's plan, which was extremely flexible, and standard defined benefit JSPP type plans is that the defined benefit plans often have a an age of 55 point where if you leave the institution and you want to take out your funds, that option ends at age 55. If you terminate after 55, then the only option you have is either an immediate or deferred pension. Queen's and the Queen's pension plan has been super flexible. We've allowed people all the options right up until age 71 when they have to make a decision. So with that in mind, it was agreed to during the negotiations that there would be a phase-in on the ability to withdraw funds regardless of age. So for the first 3 years after conversion, so from 21 to 24, a member who terminates employment, retires, leaves the university, has the ability to take out all of their funds regardless of age. So for the first 3 years, 21 to 2024, all options are still available. For the 7 years after that, from 24 to 2031, members who terminate are able to take out their Queen's funds regardless of age. If they're over 55 at that point in time, they'll be required to take a pension on the UPP piece. So what I'm saying is that for the first 10 years, from 2021 to 2031, the bulk of your asset under the Queen's plan is completely transferable regardless of age. After 2020, after that 10-year period, then the full rule of the UPP is in effect. So the magic line of being able to transfer out or not is age 55.
Thanks, Bob. We have had a couple of questions around how the years of continuous service is calculated for the purpose of the 80 factor. I'm just wondering if you can comment on that.
Sure. The short answer is that the date of hire, your last date of hire until your retirement date is the applicable period of time.
Okay, I think that brings us kind of to the end of our time. Barb and Gail, did you have any closing comments about where we go from here on the UPP?
Thank you for having us here today, and thanks for all the questions. And I look forward to engaging with the members going forward in the spring with the UPP Statement of Investment Policy and Procedures, and hopefully making sure that everything goes smoothly on day one and we build something that everybody's proud of.
And I'll just echo Barb's comments, and once again, thank you for the opportunity. I wish we were actually in the room and could see our members, but thank you for the opportunity to have our first real meeting with future members, and we look forward to many more, and the next one's in person. Thanks.
Great. So just in closing, I know we did get some questions that are quite specific. And again, I'd like to remind everybody that if you want to email those questions to hrpensions@queensu.ca, we'd be more than happy to answer those questions as fully as we can. And I guess just in closing, I want to thank all of the presenters today for their time and effort. And I think it's been a great discussion. And for all of those in attendance today, I'd just like to wish you all a very enjoyable and safe holiday, and we look forward to hopefully seeing people in person in 2020. So thanks again, and as I mentioned, this meeting will be posted online for those that were unable to attend or for those that wanted to see it again. So thank you so much.